have you on a bad line, Jonathan. We'll try and fix that. But we have our own Ajay Srivastava of Dimensions Consulting also join us. Ajay, how would you look at this entire complex of Fed speak, Fed action and the press conference? What's good for India? What's not good for India?
I think the good part is that, we have just the Fed alone, Lata, increasing the rate. We have all other central banks on a spree, which is loosening up the market, including our own Reserve Bank. So to that extent, the negative impact has got mitigated to a large extent because the Indian Reserve Bank wants to lower the rates. The European Central Bank is easing up still. So, so that effect, we have got a little more insulation from the global forces. That's one. And I think the second part is that will it be bad or good for India? I think it's a given to us that any rise in interest rate cannot be good for India globally because one reason is we access a lot of capital, we borrow a lot of money. You saw already the fact that the debt, the debt raising has gone down in the last 6 months and so on. The housing finance companies borrow a lot from the US market. So to that extent, the cost of fund definitely is going to go up to the Indian economy by and large. But having said that, I think the good part of the situation is today, in spite of this volatility, that a great amount of our stock market is insulated by the local demand, which is not necessarily, influenced by FOMC result, etc. So I call it there is a Fed market of Sensex and Nifty, and there is a faith market of the rest of the, market. So the faith market continues to be strong, continues to be bought into. The Fed market has seen outgoes consistently over the last month, and therefore you see the weakness. So overall, yes, it's a negative. The cost of fund will go up, but it'll have such a dramatic impact, perhaps no, because it's getting balanced by reduction of rates in India and a loosening up of monetary policy in India. So that's been a counterbalance. So not such a great negative, but yes, the cost of fund do go up.
Okay. Well, I guess all of you are also wanting to parse what the statement will say as well as what the press conference will say. So let's actually get back to Steve Liesman. He's had a fairly detailed analysis, a poll cum survey on what we should watch out for in Yellen's statements, the choice phrases that we should watch out for. Let's listen and we are back to all the four of you.
If the Fed announces a hike today, it will have been, folks, 6 years, 6 months since the end of the recession, 7 years since they hit zero in December that year, 9 years, 6 months since the last rate hike, 11 years, 6 months since the last tightening cycle. I believe I had kids who were 6 and 4, one now going to college since that first time 11 years ago. Now, what to expect from Fed Chair Janet Yellen and the Federal Open Market Committee. Today, they have a major challenge explaining their actions to the street on the one hand and to the public on the other. The street wants to know about the policy outlook, so here's some of the things to look for. Does gradual path make the statement? In other words, how they describe future rate hikes. Some debate about whether or not they lock themselves in with language like that. Expect some positive economic commentary in order to justify these hikes. Look in the summary of economic projections for the Fed to lower their own forecasts about where rates are going to go. Does Yellen signal some form of a pause at the press conference? And then does she explain future policy goals so that the street itself can factor in where rates are going? We're moving from an era of what was pretty clear monetary policy goals. It was to increase inflation and reduce the unemployment rate. But how does Yellen today communicate those new goals from raising rates? Is it to keep inflation from rising, stop unemployment from falling, or is it simply to take out insurance on a potentially overheated economy and potential inflation in the future? It's a major challenge communications-wise. She has to explain the path to markets and the reason for higher rates to the public.
All right, that was Steve with the survey.